Hello, folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at Trade Station. It's great to be with everyone. All right, start with a few disclosures here. One second. Had my other computer with my sound on. Sorry about that. All right. So we do these on Thursdays. Look at some of the interesting things happening in the market, showing some of the ways to use Trade Station's platform to discover opportunities and to react to them. We have actually a new little tool we want to share with you guys today. I want to just give a shout out to some of our developers here who created a really cool indicator that I'm not going to be able to give it to you guys. And we also put some notes, important information in the chat if you want to check that out. I'm going to show my standardized returns of some ETFs. Remember, we use ETFs kind of as indexes, just to see areas of, in the market. And so wanted to just provide this information. Let me give this a chat. Okay. So also don't forget that I am going to be in Miami the week before Thanksgiving at the Crossroads Summit, which Trade Station Group is sponsoring. CrossroadsSummit.com is the website. There are going to be some really interesting speakers talking about changing trends in the world of business and economics, and I will even be interviewing some of them. So hopefully you can make it November 21st and 22nd, CrossroadsSummit.com. Now, if you go to TradeStation.com and you go to Insights, you will see this is our blog, and here's our summary for today's blog. If you actually go here, you can see that we have a link here to the Crossroads Summit. And then also our State of the Market on Monday, coming up, remember, on Monday afternoons at 2 p.m., we do essentially a kind of review of indexes and some of the major charts. We kind of look at the level of sectors on Monday and look at the kind of faster moving information on Thursday. So that's kind of how we break down some of the things that we cover here. And here's some things we want to look at. I'll mention here that in the downloads, we have a new zip file. If you actually go to that, and this is what the workspace looks like. This has a new indicator called HB low, high bar, low bar, basically. But and we're going to get to that. But this indicator here, so you're going to want to go into the zip file. There's a new ELD in the zip file, and which will allow this workspace to work. So this is something that you guys can kind of look at. So I wanted to let you know about this is now available, and we will get to it. But I think to me what is most interesting here overall is just the fact that we have the beginnings of signs of some rotation toward things like the Russell and banks in particular. We kind of talked about financials for a while, and they just kind of continue to have interesting action here. So I want to just really quickly, we look here at the actually look at the the chart we have here, and I think on this chart, the things that stand out to me was that we just continue to see the advanced decline line move higher, but the 50-day moving average speed. I've just noticed this sometimes where you know I don't know anyone else who has used the rate of change of a moving average. Maybe some people have, and maybe some indicators incorporate parts of that. I think there are aspects of that when you look at things like MACD and the histogram of it's rising and falling and stuff like that. But I think the key thing is that this is something I kind of use. You can code this a trade station pretty easy. It's included in the studies I give you. But what it shows here is it shows you have this kind of period on the intermediate term kind of time frame when you have a period of intermediate kind of neutrality, and then you can see when it gets above the 50-day and it sits for a week or two, and then it has acceleration. And essentially this was kind of right around here, we had a similar sort of process, and now that acceleration is kicking in. I think it's important to realize, though, is at a certain point all of this downside goes away, these negative days, and that actually creates the potential for this to actually move higher, because that is still in the last 50 days. It won't be for long. I don't, on another chart I have an actual counter. But the key thing here is that this period of weakness here will soon will soon leave the trailing 50 days, meaning that negativity in the moving average will also fade. So this thing here is we're seeing the intermediate term kind of trend accelerate. Now we had kind of talked about this level here, and it's obviously important that we consolidated above this level, and then consolidate above the July high, consolidate above the September high. Actually didn't even consolidate above that, just broke through it and continued. So I think right here, this is actually last week's close on the 11th right here. Look at how we just came down, tested it, and continued. So, I think we have to realize that this is a market which has a very, I mean, you never want to be complacent or anything, but this is not giving any kind of real bearish signals. This is something where we've been talking about this trend for a while, and we seem to be now in that spot where this is the third or fourth inning of this uptrend, maybe the sixth or seventh. I'm not always sure exactly where, but the key thing is we're now at a spot where the movement accelerates and gets more sort of confident, but we have not yet reached potentially the state of complacency. And some of the ways we know that I think are important to look at. First of all, let's take a look here at a daily chart of the VIX, which is still relatively high. $VIX.X. From my perspective, this is going to be something that might actually be a positive potentially, because see, it basically isn't going any higher, and simply the VIX dropping as fear leaves the market, that alone can be a potential sort of catalyst. I think it's important to kind of realize that. And then I'm not sure what to think of the 10-year Treasury here. We had these strong retail sales today, and we might be in a spot. In fact, I got to just show you this now. I mean, all right. First of all, Atlanta Fed. This is tracking GDP for for the current quarter, and now here we are, just pushing above 3%, and this is, I think, pretty interesting. So I mean, right now we just have to remember that this is, according to FactSet, and their summary of analyst estimates right now, this quarter, is estimated to be 3 to 4%. Looking at analyst numbers, when you include the normal sort of variation, FactSet predicts that it'll be 7 or 8% by the time the quarter is done. But after this quarter, meaning the quarter ended, in September or October, if you're, fiscal, whatever, you're one month off. After that, we have 3 months of double-digit earnings growth. If you look at the analyst estimates, now those analyst estimates were created before GDP was running above 3%. So I think we have to realize here is that those numbers, which already sounded kind of positive, don't include the most recent sort of data, retail sales surprising the upside in particular. So I said it last week, and I still think it's very much the case, is that we're in an environment now of an accelerating economy and slowing inflation at the same time. This will happen a few times in our lifetimes. That we might be able to say that, in this sort of environment. And so I think at this point, that's kind of where the market is, and that's why there has not been much of a sort of weakness here. Now, let me just kind of go through some things here, because there's a lot of interesting stuff. I want to show you, which is interesting to me here, if we look at something like the Russell 2000, the IWM ETF. For example, yesterday was its highest close. We have it on TradingView as well. If you look here from the top of the article and you look at this TradingView idea, but this was the highest close in almost 3 years yesterday on the Russell 2000. And I want to now point out the BKX, which is the bank index. Oh, there we go. This, has some. We talked about the bullish breakout in this before. It's kind of triangle, but I think right now when we look at the banks, we're also in a situation. There was an article just this morning on S&P Global, basically saying that large regional banks have high capital levels. They have, basically, their tier one equity exceeded 13% for the first time since 2015. So basically, what it means is, these guys are not taking much risk. And I think it's the same thing when you look at the stock market. There's a lot of cash on the sidelines, and margin levels, if you look at it, it comes out, somebody reports it. I can't remember. There's an organization that reports the margin that it is not at highs. So the market's at highs and people are not leveraged. The market's at highs and money is in cash. Banks are doing well and breaking out, but they haven't even yet started cranking up the the actual risk and capital use yet. So the fact is that these things, in many ways, it is conceivable to see how they actually kind of increase from here. So from my perspective here, what we're seeing in banks is actually something that could be something where in 6 to 12 months you look back and you realize that something significant was happening. There were significant opportunities because the fact is that with the economy where it is and the yield curve, having steepened and a lot of other of points like that, the situation in the banks is that they have a lot of negativity in them still, and they're starting to surprise. So we might look back at this earnings season right now with the Nasdaq. Look at the Nasdaq here. The Nasdaq, and we said this on Monday on State of the Market. The Nasdaq did not break out. Oops. $ NDX.X. What do I do? I can't type now. NDX.X. All right. The Nasdaq has not broken out. Nasdaq is still stuck below these levels. The Russell, it's closer to breaking out, and the other indexes, have broken out. The banks have broken out. Look at the software, the semiconductor, the SOX, nowhere near breakout. Large rejection yesterday. XLK, the technology ETF, large bearish outside day yesterday. So from my perspective here, these are just things that we have to realize. There has been this theory for a long time that we're going to see money shift away from the mega caps. And it's like, anything else where, you have a theory and then you look for confirmation. Well, these different things are potentially telling us that we have some confirmation, at least for now. The other catalyst, and I think we have to recognize this, whatever you think about politics, is that Trump is associated with small caps. And most of the political stuff I have seen recently suggests that things are now more in the direction of favoring him next month. So the thing here is, look what happened here when Trump got elected in late 2016. You had a very strong small cap rally. So I think we have to also realize that. So this is kind of what's happening here. And people have been talking about the potential opportunities in small caps for a long time. And now we're getting some technical things that tell us that. We're getting a potential catalyst with the election that's telling us that. We're getting some earnings and some price action in the banks, which are a significant part of the small caps. All those things kind of coming together. So I think we have to just kind of, respect what we see and just recognize that it seems to kind of be there. Here's our trading view idea, by the way, on small caps. You might want to kind of check this out. We had done some different sort of things on this back in July when it had this pretty significant breakout, and that's why we're calling it Act 2. Kind of like Act 1 was July with the big rally in small caps, which we had right here. We had a trading view idea right around here because there was this trend line. We basically had talked about the fact that what cannot go down might go up. Sometimes when things cannot break the support to the downside, you have this violent rally to the upside, and that's what happened here with small caps. And now it's more of just like a continuation of these higher lows on the monthly candles, basically now squeezing toward a high. So this is something I think we have to keep our eye on because there is a history and a pattern historically of this happening. Now, talking about historical patterns, I have to mention this because everyone talks about rate cuts. But let's take a look back at 1995. This is the Fed. Now, remember, the Fed has changed the kind of numbers they've had. Like, I don't even know what they are. But they've had different numbers that they use for their what do you call it? Their target. They used to have one number. Now they have this like range or something. But this thing is a great thing to bookmark on Fred, which is the St. Louis Federal Reserve economic data. But this actually will show you the long history. It kind of corrects for all the different versions of interest rates that the Fed has used over the decades. I'm pointing at this for 1995. This was we've talked about these parallels of 1995 soft landing Fed cuts, but look at 1995. The Fed, basically went from 6 to 5.25 over the space of April 95 to May of 1996. So 75 basis points in 12 months. We've gone 50 so far. Okay, now expected to have another 50 this year, but now people are saying maybe not. The key thing is, and I think we really have to remember this, is that The great bull market of the 1990s was not, I mean, the last part of it, the last year, basically, in fact, when do they even, I'm sorry, they cut rates here in at this point in 99. But the key thing is that the first chunk of it really was not caused by rate cuts. It was caused by economic growth, earnings growth, money entering the market, sentiment improving. And what do we have now? We have sentiment that is bad, but getting, apparently getting better. But we have money entering the market. We have earnings improving. We have economic growth. So let's just remember that. Now, talking about sentiment, it was interesting for me to see today that the American Association of Individual Investors actually had their bullish sentiment come down. So again, this is kind of showing us that we are not yet in the euphoric, giddy sort of stage. We are still cautious. And I think that is really what is important here is that none of the measures of reckless euphoria are present. The VIX is still high, the margin debt, all that stuff we've mentioned. All those things are kind of telling us that there might be still runway here ahead of us. Now, I also want to mention that, today we had oil inventories that were lower than expected. We had kind of talked about on Monday. I think we talked on Monday. We talked about ExxonMobil. Just when it was up here at this level, and just the potential for it to not remain at that level and move to a lower level, which it has. But I think we just have to also realize here is that there's just a lot of evidence that's still kind of out there over time of inflation moderating. There was a fascinating interview this morning on CNBC with the chief operating officer of Blackstone, and he said, because they own a ton of property. He said rents are coming down; they're under 2%. He said for the first time we're seeing wages up less than 4% at our different businesses. Because they have all these private equity investments. The key thing is that there is a lot of evidence of inflation still coming lower. So we really could be in an environment here where we have high real interest rates, we have strong economic growth, we have falling inflation, but interest rates remain relatively high. And all that actually gives more runway ahead. So I think all that is things we want to kind of bear in mind. All right, so also, I have to mention what's happening in gold because gold is going up despite the American economy. And in my view, there's one reason to really, or at least I'm not going to say one reason, but one catalyst, and it is the spreading weakness in Europe. The euro is potentially here in a very ugly kind of setup. And if you look at this on like a weekly chart of the euro, I mean, this is a long-term thing, but look at this, how it's just kind of struggled here. So I want to kind of point this out because the relationship really to look at for gold is not the dollar. It's the fact that the euro is kind of, really struggling as a currency right now. And they cut interest rates at the same time our economy is looking better. And, I think that there is that kind of elephant in the room of the Ukraine situation is not really going the way I think people in Europe want. Who knows how it will resolve? But I think people know it's out there, and that might also be something that creates another risk here. So, so I think it's interesting. I just want to point this out that something is happening here of the euro weakening, gold benefiting from that. It's just kind of under the surface, moving forward. All right, now. This week we had this weird pre-announcement from ASML, which obviously hurt semiconductors. And then the other thing after that was Hedgeye put out a short recommendation on Applied Materials, which is also a semiconductor equipment company. So for me, this is something we need to be aware of. These are the picks and shovels of tech, and they are the leading sort of indicator. Let's just look at, I hope you don't think I'm too crazy for this, but look at Moody's back here earlier in the year. Moody's broke out to new highs before the financials did, right? And now we're seeing, so that's a pick and shovel, because if you're issuing debt or whatever, all these are the guys who deliver these core services, and they reflect first what's happening on Wall Street. And now look at what's happening with AMAT. So I think we just have to realize that this is a situation of AMAT and ASML. ASML is actually a massive company. It does not trade a lot, but its revenue is huge. Its market cap is relatively big. It is an important semiconductor company in the industry, not in the trading world, but in the industry. And this was an ugly pre-announcement. So I think right now we could be in a spot when, yeah, Nvidia has the Blackwell coming and everything else. There are some other names out there. We did a trading view idea on Seagate, this kind of bull flag breakout. This one here, we looked at it, but this was the one we did a trading view idea on, and it's progressing higher. Things like Micron also in that spot. These are relatively low valuation semiconductor names, but I think overall we're in a spot here where we have to realize that the chip trade is extended, it's old, and there's a few names in there left, but there's more and more signs of it narrowing down to just Nvidia and Broadcom, if you really think about it. And I guess Taiwan Semi. So I'm not saying it's all dead, but the fact is that you have some in there, and then you have a lot of others now that are just not hitting new highs when the overall market is. Look at MT Breadth. MT Breadth here, which is one of the workspaces we provide, showed yesterday we had 112 members. This was 2 days ago. One of the weirdest days. In fact, I want to say this was a pivotal day. This was the day when basically the bad news came out on ASML. We had 112 members of the S&P hit new 52-week highs. So the last time we had a down day, and so this was the second biggest number of new highs in a while, but I'm trying to remember. The key thing is that it was a negative day on the S&P, down 0.5%, and 112 companies hit new 52-week highs. Very unusual. And so it actually was a big sign of rotation. We are getting these signs, again, of faltering leadership in the large caps. And so I think we just need to kind of bear that in mind. Financials, industrials. And here's another little thing that no one talks about, but throw in the presidential thing. We have two names here. CMC is Commercial Metals, American Steelmaker. STLD, Steel Dynamics. Both of them had earnings here. Both of them are moving, and both of these have that potential. With all the talk of tariffs and steel and all that sort of stuff, these are, I think, the only two steel makers left in the S&P 500. I want to just kind of point that out, because that is another thing here where is it a buy the rumor, sell the news, which means November 5th, 2 to 3 weeks, whatever that is. It's a date on the calendar. Is this something where people say it's an opportunity toward that date? Just want to point that out. Speaking of the date in November, it's a weird one. The Fed meeting moves to Thursday after the election. The election's on Tuesday, Fed meeting's on Thursday. I've never seen that before, but I wanted to just highlight that to you guys. It was a weird week. So actually that week we're going to move our webinar an hour later. So it's at 3 p.m. on the 7th of November. So today we had, I just saw a note, but Goldman Sachs, BMO, and UBS have raised their targets on the S&P 500. Another thing that did pop out to me was Walgreens Boots. This company has been a train wreck for a long time. They borrowed a bunch of money to buy a bunch of stores that haven't made a bunch of money, and now they basically are down a bunch. But the thing is that now they're looking at cost cuts. And a company like this, member of the Dow Jones Industrial Average, a major footprint in the American economy. So I think at this point, people might want to think about, there's a lot of tricks. It's, Christmas coming up, strong economy, strong retail sales. They have massive locations and square footage in the retail world. They might be able to do some clever stuff to make more money again in those, front of the store that's been doing so poorly for them. Meaning when you go in the Walgreens and it's like basically a huge store full of stuff that no one buys, and they all go back to the retail, they all go back to the pharmacy. They have a real opportunity there. And if they start to turn something like that around, you're looking at a stock that's been really down a lot. So WBA might be something where people start thinking about this as some kind of potential turnaround. All right. Now I'm going to show you this special indicator. What this does is this, and I haven't looked at it today, so let's see what it does. I will warn you that when you load it, it takes a little bit of time to load. It's a data hog. You might want to actually change the intervals on it to make it quicker. But the key thing with this is, all right, so I loaded some of the most active members of the S&P in here. And what this tells us is, this tells us stocks. Here we have Palo Alto Networks. I had this created because Palo Alto Networks, I'm saying I wanted to find, you see them, like I saw this breakout right here, and it's like, all right, that was an interesting one. We did a trading view idea on it. It pushed to the highs. Great. But how do I find this? Because here, what is this? It's not a 52-week high. It is a trend line breakout. It's something, but I don't exactly know how to explain it in a chart. I mean, it's above the Keltner channel. You can say a lot of different things. So what I did was I asked my developer friend, I said, show me something that's going to show me a stock is the highest in so many bars or the lowest in so many bars. So right here, it was like the highest in like 65 bars or something. So this is a sort of thing where if a stock's, this is useful potentially when things are in ranges and they start to move higher, but they're not at the 52-week highs yet. So one of the ones that really I wanted to talk about with this was SQ, the old square block. Now, this stock is to me this is one that to me has been interesting because here's a stock that basically is just um, starting to work off the lows. It's just been kind of languishing down here. And so what this will tell us here is, wow, this just hit its highest level in more than, in something almost half a year. Well, that's interesting. Why is it kind of doing that? So by looking here for values, kind of 50, 80, 200 range, you're going to start to see things that are starting to move upward in their range, but not yet at 52-week highs. The same thing for things that are starting to hit the new lows, but are not actually at the lows. Things like LRCX, for example. So this was one that it would have been flagged right there. Lamb Research, names like that. So I wanted to kind of mention that. I think this is interesting because for me, what was interesting to me was to see these names like the Palo Alto break out of its range, or a name like Block here, which is to me, something that is actually a name that I'm starting to kind of follow again because it was a very interesting mover back, 2019, 2020, 2021. And again, it's one of these kind of, it is kind of a financial. It's also, one of the kind of smaller names. I wanted to kind of point that out. So go ahead and just look at a few individual things here, like Tesla. We did a trading view idea on this, and with earnings coming up next week, I want to just point this out because people might view this as a bearish flag. Um, from my perspective here, if you look at Tesla, I mean, this stock, it basically has been negative almost all of the year. This is where it ended the year, right there. So basically, if you look at this year from this line around 248, it's basically only been green on the year like here, and now it's red on the year again. So we have a year where, in the S&P 500, we can actually just go to our price grid, and we'll go to, let's bring in the S&P 500. We'll go to S&P 500. Be interesting to know how many members of the S&P 500 are green on the year. Well, we'll find out in a second. But I'll tell you one thing, Tesla is not one of them. So as we get toward the end of the year, there's things like window dressing. There's things like tax loss selling, and then there's things like the fact that the overall business itself maybe isn't terrific. Now we also can see with our next earnings date tool that earnings are next week. So this is one that people might be kind of thinking about. I didn't have time to get Option Station Pro going, but this might be one where people are starting to kind of look at some potential spreads to the downside and looking for a sort of maybe more aggravated sort of selling pressure into year end. So I think I want to really point this one out. Now, to the upside, there was a potential one that did jump out, potentially Uber. Now, it's funny. We did trading view ideas on both Uber and farther back on Expedia. And both of them have worked to the upside. Now, look at how Uber's pulling back because there's a report. I can't remember where it was, but it's all over the news that they are potentially thinking about buying Expedia. So here we have a stock that has had an interesting pattern. Speaking of Tesla, they broke out to new all-time highs here because Tesla's robotaxi event was not, viewed as a big success. And so here we go. This breakout, and now it's pulling back pretty interesting. This is to me one that I think is an interesting name that I wanted to kind of point out. Do you know that Uber is an industrial stock? It's not. It's not a tech stock. It's in the XLI. Why? Because it's a transportation company at a time with the economy, moving back over 3%. Something to think about. Now, Expedia was one I want to point out because we're seeing something here. We're seeing cruise ships, airlines, hotels. All these are consumer discretionary. So while Uber is not technically a consumer discretionary, they all kind of fit in the same thing of discretionary travel and all that. And this area is kind of, I mean, there's a general strength in the transportation thing and in the general kind of leisure and hospitality thing happening right now. So I think we got to have that on our radar. So those are the main ones I wanted to talk about right now. There was one other, and I don't know that much about it, but I want to just mention it, which is Viking Therapeutics. This company reports earnings next week. This company has some kind of obesity drug. So it's interesting. Last time here they reported they had some news about trying to commercialize it. So this could simply be one to think about for next week. I'm not going to, I'm not going to speculate anything. I just want to mention that this might be one that sees some movement. So we'll see you guys on Monday. Don't forget to check out our trading view ideas and to check out the new workspace with this new indicator. Remember, you will have to go into the ELD, load the ELD with that HB LB before you actually open up the workspace. And I'll see you guys on Monday on State of the Market. Great to see everyone.